All right, welcome back to the snippets. This is the second part of the transactions. There may be a third or fourth too. I don't know. We'll have to see. Let's go over some more transactions and types and how to handle them with the accounting equation. So this next one, we're going to be dealing in the asset section. We're really going to be focusing only there. So let's say that we purchase some supplies on credit, excuse me, on cash. So we're going to take our cash that we've donated or put into the company, and I'm not worried about all the prior transactions. I'm just illustrating what is going to be impacted on the accounting equation as we do this. So let's look at this from this standpoint. If we purchase cash, if we purchase supplies using cash, supplies are things like your paper, pencils, notebooks, things that you're going to use maybe in the office. We'll call them office supplies. And so we're going to spend cash to get those. Well, those supplies are things that are they're assets too, and we haven't used them. So remember the expense recognition principles that we're only going to expense these things when we use them, not when we paid cash for them. Okay. So we bought these supplies with cash. Let's say we bought $2,000 worth of supplies. What we're going to do is we're going to see it in our asset section of our accounting equation is we are going to subtract $2,000 from cash, and then we're going to add $2,000 to our supplies account. So we see that in the accounting equation, we've increased one asset, but we've decreased another asset. And by so doing, we have kept our accounting equation in balance, regardless of what's happened before it. Okay. But if the owner has contributed cash, we're going to reduce that cash account by $2,000, but we're going to increase our supplies account by $2,000. So we're going to stay in balance there. All right. The next one is, let's say we're going to purchase another piece of equipment for cash. It's the same exact concept here. Let's say we're going to pay $8,000 for that piece of equipment. So we're going to subtract cash from the asset section, and we're going to increase equipment by the $8,000. Oops, I lost my cursor. I'll try and keep my stupid jokes to myself because it usually takes up too much time, but I just thought of one about the cursor. Anyway, from junior high. So anyway, so that's what happens when we're purchasing things using cash. Cash is an asset, and when we're purchasing items or anything else, whether it's inventory, supplies, equipment, vehicles, it doesn't matter what we're buying. If we're buying something, we are going to see it change in assets. It's just going to be dealing with the asset side over there. All right. So the next thing is, what if we buy something, but now we're just going to say, hey, we're going to owe it to you later on. All right. Let's look at it from that standpoint. So instead of paying $2,000 cash for supplies, what we're going to do, and the $8,000 for cash, so I'm going to just delete those. We're still buying the supplies and the equipment, but instead, what we're going to do is we're going to increase our liabilities by $2,000. We're going to call this one accounts payable because we're going to owe it to our vendor. That's why we're going to call that accounts payable. And if we paid $8,000 for this equipment on credit, then we're probably going to increase $8,000 to our notes payable. All right. So we've seen the asset side increase by $10,000 with the supplies and the equipment, and we've now seen our liabilities increase by 10,000 with the accounts payable and the notes payable. So we see now that 10,000 equals 10,000 in this transaction. We're still in balance. We're still good. All right. Now, I'm just kind of following my book here so that I can make sure I cover everything. Let's go ahead and do this. I don't know how much time this has already been expired. I don't get to see the little timer, but hopefully we can have it. It doesn't get too long. Let's say we provide service to a company or somebody else for cash. All right. So let's say we're going to receive $3,000 cash for doing work. Okay. So in that accounting period, we're going to see our revenues over here. If I can get that cursor over there all the way. Let's say we did $2,000. Let's say 3,000. So we have different numbers than what we just used. We're going to see a $3,000 increase in the revenue section. Okay. And then we're going to see an increase of $3,000 in the cash asset side. All right. So that's how we're going to see it impact. Our revenues are going up, and so are our assets. Okay. They're both going up. So we're equal. $3,000 asset equals $3,000 revenue. So we're still in balance. Now, what happens if we do work, but they're going to pay it to us later? Okay. This time, we're not dealing with cash. All right, let's just go ahead and put that this was cash here. All right, and then let's get this back to the revenue section. Okay, so in our accounting, in accrual accounting, we don't care whether we received the money or not. If we did the work, we're going to count this as a revenue. So let's say we did another $5,000 worth of revenue. We are going to see a $5,000 increase in an account that's an asset that we call accounts. I'm going to spell this receive I before E except after C. I Receivable. I think that's it. Accounts receivable. I usually just put A/R, and I'll probably do that going forward. But I wanted to make sure I spelled that out for you. Even though acting cash, we're still increasing our revenues. It's still a revenue, and we're still going to log it as a revenue. So it's very important that we understand that whether it's cash or whether they're going to pay it to us later, we're still increasing our revenues and we're still going to increase some type of asset because we have claim on that accounts receivable. That company, we're the creditor at this point, and we have claim on the company we did the work for, their assets. And so we're going to get that $5,000 from them. All right. So I'm going to stop this snippet now. We're going to go into some expenses now in the next snippet or well, I mean, there's going to be a bunch of snippets. You can just jump around if you want. So anyway, there you go.